Hi guys, welcome to this Moneycontrol live stream. You're watching, morning trade with me, Nandita Khemka. Well, the setup this morning is not looking all that great. We've seen a sell-off coming in on Wall Street last night, wherein the Dow clocked in its worst session since March 2023. We have the GIFT Nifty indicating a gap down start for our markets as well. So 200-point kind of a downtick on the GIFT Nifty. Looks like we are in for a pretty much subdued and gap down open this morning as well. But of course, over the next 30 minutes, we'll be getting you a global view on what to expect when it comes to the Fed's rate cut trajectory. We also have a technical expert on the show. We'll be talking about a whole host of stocks. We'll be taking up all your stock-related queries as well. So if you have any queries, keep them coming in on our YouTube feed. We'll try and take them up. But of course, before we move any further, let's take a look at the top headlines at this hour. Hotter than expected January inflation print spooks Wall Street. In fact, all major indices drop over 1%, with the Dow suffering its worst day since March 2023. Treasury yields also shoot higher. The US dollar rises to a 3-month high. Asian markets open lower following a weak handover from Wall Street. The Nikkei retreats from a 34-year high, and the GIFT Nifty, as I mentioned, is indicating a gap down start for the Indian market as well. Crude prices rise despite a hotter than expected US inflation print. The Brent hovers around $82 a barrel mark, and the gold rates also slip below that $2,000 mark for the first time in 2 months. Meanwhile, Bitcoin has also dropped below that $50,000 mark a day after hitting the highest level since December 2021. Among key earnings to watch out for today, M&M's Q3 profit may grow 45% on the back of strong auto volumes, but margins are likely to decline by over 20 basis points on a YOY basis. Also watch out for numbers from NMDC and Glenmark. Well, on that note, without any delay, let me bring on board, our global guest this morning to take stock of, what to expect when it comes to the Fed's rate cut timeline. We're joined by Geoffrey Dennis, independent emerging markets commentator. Great to have you on the show, Geoffrey. Hope you're doing well. But given the fact that we've seen a hotter than expected inflation print, the chances of a March rate cut now are virtually zero, right? Because even the Fed chairperson had said that, March rate cut looks unlikely at the juncture. But chances of a May rate cut are also off the table. If you look at the Fed watch tool, what are your own thoughts?
Well, I've thought for a long time they wouldn't cut until June or July because, quite simply, I didn't see the argument for cutting with the economy continuing, of course, to do unexpectedly well. And I think what this inflation report does, it was not a disastrous report, but it was obviously stronger across the board than expectations. And the reason you had this big market reaction is because you've seen a lot of heavy profit taking. And as you imply, what's happening is people are pushing their first rate cut forecast out. Now, I think it's going to be June or July, sometime around the middle of the year. But, the narrative is still there. Rates will come down, I think. But this is a pretty negative development here with this inflation story, and certainly pushes that first rate cut out further.
The Fed's dot plot is expected, in the March meeting, right? In December, the Fed had indicated 75 basis point rate cut this year, which meant somewhere around 3 rate cuts, right? But do you think there's a case or there's a possibility of the Fed scaling down, the quantum of rate cut for the year, perhaps a 50 basis points, or do you think that's far out?
I think that's doubtful. I think they'll probably still stick with the 3 rate cuts. Obviously, the main development in recent weeks has been how the market has come into the Fed. Market's gone from 5-6 rate cuts now to something more approaching 3, and I think 3 is still about right. I suppose the risk to the 3 rate cut scenario would be 2 as opposed to 4, but I still think 3 is about right. For me, the issue about the inflation reports was, first of all, it looks like headline inflation is settling down around 3% plus, which is not good. It's okay, but we need inflation to go lower. Core inflation is coming down, but it's coming down slowly. It's just ticked below 4%. And as your viewers may well know, the big story within this inflation report was the persistently strong service sector inflation, especially things like housing, or if you like, rent, including things like airfares. And so you need to get this service sector inflation down before the Fed is going to feel able to reduce interest rates. So I think we're going to have to wait for several more months. And therefore, my call is this remains the middle of the year.
Middle of the year is when, a rate cut could be expected from the Fed. But, given the kind of equity rally that we have seen in the US, S&P 500 topping that 5,000 mark, do you think the street has not factored in anything less than 4 rate cuts? Do you think that pricing in is yet to be done when it comes to US equities?
I suspect it's pretty close to making that adjustment now. It's hard to tell, but I would think they're close to making that adjustment. Maybe there could be a little bit more froth to come out of the market if it really becomes clear that we are only going to get 3 rate cuts. But this was such a shocking inflation report. I mean, it wasn't dramatically bad, but it was stronger than expected right across the board. There was no fluke about this. This was just a strong report. I think the market has done its work today to a considerable extent, given how much the market indeed came down. This was a huge sell-off, as you said earlier on in the broadcast. And I think what that's doing is taking a lot of froth out of the market as well. You can call it profit taking if you like, or just maybe some excessive excitement in the market coming out. But bottom line, as I say, is I don't think it changes the long-term narrative, which is that the next move in interest rates will be lower. It's just going to be later. The economy is doing reasonably well. It will slow a little bit in 2024. But inflation, I think getting that last little bit done is going to be harder than people thought. And I think that's what today's action is all about.
Also, I want to get in your thoughts on, where the US dollar is headed. It has strengthened to a 3-month high. In fact, yields, the US 10-year yield has shot up above 4.3% as well. How much of a concern would that be? Do you think there's a chance that investors may turn risk off going forward, given the fact that we've seen such a hot inflation print this time around?
I suspect we may see a little bit more selling over the next few days, or erratically, not saying tomorrow or anything like that, but I think it'll take a bit more time to absorb this. But at the end of the day, the dollar, I think, is very overpriced. I think clearly it goes up when there's a risk-off scenario and people are more depressed about how quickly the US interest rates could come down. But at the end of the day, I think the dollar is going to go lower over the course of the year. Of course, earlier this year, we were at over 110 to the euro. We're now about 107. So it's not like we're talking about big moves. But the move in the dollar that we've seen, some strengthening today, the rise in bond yields to over 4.3%, is the sort of thing that is going to pull money back into the US at the margin, and it's going to be at the margin negative for emerging markets. Now, emerging markets have not done badly through all of this, partly because China has been off, although, so it's been off the last couple of days while, we've gone into this inflation forecast, if you like. But the EM has not done that badly, but these are not great conditions for emerging markets. Above all, I would not turn that negative here, because I think the narrative's still in place. And although I wouldn't say buy today necessarily, I think ultimately we will get back to a more positive market once again. And with that, I think yields will drop below 4% again, and the dollar will begin to decline. It's just we've got to absorb this really pretty awful inflation number first of all.
Right. And, since, of course, you mentioned emerging markets, within the emerging market pack, how are you viewing India at the current juncture? Do you think India, it has remained a bright spot, when it comes to the emerging market basket, right? Do you think, India will remain immune to these shocks? Do you think flows will continue to pour into India, vis-a-vis China, given the fact that, there are hardly any signs of rebound in the Chinese economy?
I don't think it's immune. Nothing's immune from this sort of thing. But India's an outperformer this year. It's up around 2 to 3% in dollars. EM is down between 2 or 3% in dollars. It's been a good outperformer. And I think the story there remains the same. India is the best growth story in the emerging market universe. Of course, you have to see earnings growth deliver to validate some of the valuations which are there. The challenges remain the same, ensuring the budget deficit remains broadly on track and does not blow out, if you like. And I think also just to try to make a judgment call as to when you may see lower interest rates in India going forward. The demise of China over the last 3 years has been very helpful for India. And while I think a lot of the selling is now done in China, it's going to take a lot to get foreign investors back into China. And I think India is still going to be their favorite port of call if you compare India versus China. Oil prices are, they're in a trading range. They firmed up a little bit. That's not helpful. But at the end of the day, despite all these terrible events in the Middle East, of which there are many, as you know, oil prices remain very much, I think, within a range and under control. And that, of course, is helpful for India. So you wait out this global sell-off, and then my view would be India looks pretty good again.
All right, that's the view. Then with that, Geoffrey, I'm afraid we're running out of time. Appreciate your taking out time and joining in. It's late night there. Have a good night, and of course, look forward to touching base with you again sometime soon.
Thank you very much.
Thanks a lot. Well, with that, let me bring on board, our technical expert for today. Joining me is Hemen Kapadia, who's the Senior VP, Institutional Equity at Choksey Securities. Great to have you on the show, Hemen, as always. Of course, it's Valentine's Day. Everywhere you see, you will see red. But one place where you don't want to see red is on the trading screen, right? But looks like we are poised to see red on the screen as well, given the fact that the GIFT Nifty is hinting at a gap down start. Yesterday we managed to stage a good comeback, but looks like today, once again, we are heading lower. So when it comes to support levels on the index, what will you be really watching out for?
A very good morning to you, Nandita. Thank you for having me on the show. It's always a pleasure. Yes, you're absolutely right. Despite it Valentine's Day, we don't want to see red on our screens as far as the market is concerned. But we remain corrective, Nandita. The VIX, I think we spoke last time also, the VIX remains elevated because the Nifty is near all-time high. Many stocks have still indices. So the VIX has been consistently around 15.5, 16.5, around 16. We need that to be sub 13 for either the market to go up. So it had to happen. Either the VIX goes down or the market goes down. Now VIX has consistently refused to go down, so the market has gone down. And if you look at the US VIX yesterday, Nandita, from an intraday low of 13.43, it went to a high of 17.94, closed at 15.85. A huge spike, almost 14% as far as the CBOE VIX is concerned in the US. So it's taken a toll. The dollar index has remained steadfastly high. So everything seems to be pointing towards a jerk, something which would affect equities, and it has. So one gets the feeling our markets, it's been 1,000-point range, Nandita. That hasn't changed. The Bank Nifty, which was one of the main indices which sort of weightage-wise support the Nifty, it's been 6 weeks in a row, Nandita. Bank X has gone nowhere. Forget going nowhere, it's been corrective. We've seen an almost 4,000-point correction in the Bank Nifty. So our markets are tired, stretched, overbought, and we needed an excuse for a correction, and this is happening. And yes, dollar index and the VIX and the treasury yield and the statements in the US by the Fed would obviously take its toll, and that's what has happened. So I think the bigger picture remains fine. For the time being, we are taking a breather, and I think that looks like continuing till the VIX or the dollar index or the treasury yields sort of, give weight and cool off a bit.
Right, of course, volatility has been on the rise. But before I talk about, viewer queries and take up specific stocks, I want to get your thoughts on a Hindalco. 12%, sell-off coming in on the charts. Do you think it's in oversold zone now, or do you think there's more to come?
If I look at purely in intraday, Nandita, yes, it is absolutely oversold. If I look at the daily chart, 494 was support. For 495 was support. We posted a low intraday low of 496.35. So yes, frankly speaking, if the stock comes off from 609 to 496 and a mainline stock like Hindalco in a matter of 4 trading sessions, yes, the setup is getting oversold, but it's more oversold intraday than on the daily chart as of now. So 495 remains important. If that breaches decisively, then I'd say some more pain. But we are getting into a congestion area where, we've been here for a long time. So I would say, though, nothing seems to suggest a turnaround yet on technical parameters. Like I said, very strong supports here. So I believe that time being, this downward momentum should peter out just a bit. Nandita.
All right, sticking to commodities then, BPCL, there are reports that BPCL may sell 80 lakh shares worth 450 to 500 crore rupees via a block deal. It's the BPCL Trust for Investment that is looking to sell shares, and the government officials as well as BPCL will take a final call on the pricing as well as the deal size. But if you look at, BPCL, HPCL and the likes, of course, crude has once again, shot up and passed that $80 per barrel mark. In the last 5 sessions or thereabouts, we've seen some bit of correction play out. But over the last 1 month, stocks have been doing well, OMCs. And, brokerages are also pretty much positive on the OMC pack. But, for somebody who's invested or who's trading into these counters, should one look at booking out, or booking profits, partial profits, or do you think wait it out and let the corrective phase get past us?
No, as of now, I think I would prefer to wait it out. And keeping in mind the quantum of the run-up and the speed, yes, I think if you have a significant quantity, a little bit of profit booking wouldn't help. But as of now, I think it's a bit too raw. Would prefer to wait. And yeah, looking at the Brent crude charts, Nandita, there also we have a small upward bias coming in. Brent, I think, closed yesterday at 82.65. If we close above 84, I think it could be seeing some more upside. So yes, I would say wait it out a bit. We've had a phenomenal run up. As of now, things haven't changed dramatically. Neither have any important levels being breached. So I will wait just a bit.
That's the view then on BPCL. But let's talk about the brokerage call of the day. Adani Enterprises, in fact, the entire Adani Group will be in focus, given the fact that Moody's has revised their ratings upwards for, some of these, rating outlook rather, upwards for some 4 Adani Group companies. And this is after 1 year, right? And even Jefferies, they have come out with a report where they've initiated a buy call on Adani Enterprises, the target price of 3,800 rupees per share. In fact, Jefferies sees a 19% uptick in the stocks, in the stock price over the next 12 months. Looking at the charts, I think Adani Group of stocks have made a very good comeback, right, over the last, 4 to 5 months. Going forward, how would you play these stocks, and which are the ones that are looking attractive? Be it Adani Ports, Adani Green, Adani Enterprises, anything that, is on top of your list?
I think if we start with Adani Enterprises, Nandita, that remains pretty solid. And frankly speaking, it stayed, like you said, it staged a very strong comeback. Technically, it's still cheap. Why I'm saying technically it's still cheap? The high was almost 4,200 and we are still at 3,178. So, and we've spent some 8 to 10 weeks of a consolidation between 2,722 and 3,250. So frankly speaking, it can outperform. The setup seems positive. And the other stock which I like, you said which one is of the entire pack. I think Adani Enterprises is technically cheap. I believe there is a distinct upside on coming in. I'm not sure if it will outperform in a wobbly market like this, but yeah, the market stabilizes. I think Adani Enterprises should do well. Adani Ports continues to be solid, Nandita. We've posted a fresh all-time high just last week, and we've seen the market come off. Adani Ports has refused to come off. So a lot of underlying relative strength coming in. So my pick would be Adani Ports if you have a slightly shorter term point of view. And from a slightly medium term point of view, Adani Enterprises looks very promising.
Adani looking promising on the charts. But let's talk about an M&M. I saw a query on our live feed on M&M. Numbers are slated to come out today. Profit is likely to jump 45% on a YY basis. Strong auto volumes, but margins are likely to, go lower by 20 basis points or thereabouts. But auto stocks, among the four-wheeler pack, would you choose a Tata Motors, M&M or Maruti?
Tata Motors is very safely ensconced in a longer term uptrend, Nandita. So no two ways about that. M&M Mahindra and Mahindra has been one of the earliest stocks in terms of four-wheelers to do phenomenally well and continues to outperform. Maruti has been playing on and off, but as of now, I think the toss-up is between Maruti and Mahindra. I believe Maruti looks a shade better. Why? We spent almost 5 months, Nandita, between 9769 and 10,900. It is now near the high, and everything seems to suggest it is straining at the leash, so to speak, trying to break out. So Maruti could be setting up the stage for a 1,000-point move. Everything is fine with Tata Motors, but it's had a run up, a cool off, a little bit of heaviness over what situation is prevalent. And M&M seems to suggest some more consolidation before it makes an upside move. So as of now, Maruti seems best poised. Yes, the breakout hasn't yet happened. We need a close about 10,900. But coming back to your main question, I think Maruti looks better than the other two.
Maruti looks better on the charts. Hope that answers your query. But there's another query coming in on Eicher Motors. The results have come out, and the stock staged a very good comeback from the day's low yesterday. Of course, it is embroiled in competition. With respect to premium bikes, and you have Hero and Bajaj also upping the ante there. But how is really Eicher Motors poised at the current juncture? Because over the last 1 year or so, it has gained 20%, but it has underperformed the likes of Bajaj and Hero. Here on, do you think this stock is a little cheaper compared to the rest?
Yes, absolutely, Nandita. Technically, I would really go with your logic of it being cheaper. Yes, because one can see where Hero is, you can see where Bajaj is, you can see where TVS is. And the high for Eicher was 4,200 and we are at 3,854. So yes, technically it is cheaper. The setup isn't bad, but yes, there has been a little bit of a drag where it hasn't performed as much as its peers. But yes, on the longer term charts, everything is fine. So yes, I would also agree with you. I believe Eicher Motors is cheaper.
All right, Eicher Motors, that's the view then. But let's talk about a Sula. I saw a query on our feed on Sula. I seem to have lost it, but numbers came out yesterday. And, numbers have been pretty good. But, of course, it has been a recent listing, but the stock has done fairly well. Would you, keep Sula on your radar as a play, when it comes to the liquor space?
Yes and no. Yes, because like you said, it's been a relatively new listing. So I don't have too much of data to go on. But what new listing in the sense, it's been around since December 22. So it's not exactly been new. But yeah, the setup on this, despite the limited data, seems positive. We had a prolonged consolidation between 430 and 535. We gave a breakout, posted a high of almost 700. Now we've pulled off again. So a consistent higher tops, higher bottoms has been seen since the listing. Does that situation change now? I don't think so, at least not yet. So if 535 holds, which I think it will, yes, I think it makes sense to keep Sula on the radar because we've corrected significantly from 700 almost to 555. Downside now, I believe, remains a bit limited.
All right, downside limited on Sula. Hope that answers your query on this particular stock. But the next query is coming in from Mahesh Pawar. Wants to know your thoughts on a Gensol. This stock has seen a good rally over the last 1 month, somewhere around 35% uptick. But it has flattened out. If you look at the last 5 days, hasn't done much. Any levels that you're watching out for here on Gensol?
I think it's been newly listed on the NSE. There is data on the BSE. So we've had consistently higher tops and bottoms, all-time highs, no known resistance levels, Nandita, because just 4 trading sessions ago, it's posted a fresh all-time high. But yes, on the short term, it sort of cooled off a bit, simmered down. I believe it's a correction within a uptrend. It remains in an uptrend on all time frames, short term, medium term, and long term, Nandita. and that doesn't change. So yes, maybe we take a few trading sessions more to consolidate, but the setup seems promising. And yes, I think one can keep an eye on it because every move has been followed by a correction. So it's been a sort of a constructive move, and the picture still remains fine.
All right. I just have time for one more query then. Bhatt Yavar wants to know your thoughts on SJVN. Of course, we saw a very sharp sell-off coming in some of these PSU names, right? And SJVN, of course, has been at the receiving end of it. In the last 2 sessions, it has lost nearly 30%. What should one really do with an SJVN? Because numbers weren't all that enthusing either.
Well, elevated markets, Nandita. We're sitting on top of a major rise. So, like you said, a little bit of weakness in the numbers gets punished badly by the market. So, yes, the valuations are rich, and even if the results are not that bad, but if they don't beat the street and don't live up to expectations, the reaction has been brutal. So I guess that's what happened. SJVN 170 to 100 in just 7 trading sessions. I mean, that's quite strong. Support at 100. I believe the longer term picture doesn't look bad for many of these stocks. There's been a major cool off, sell off, however you term it. But all of these stories, at least from a longer term point of view, the PSU pack seem quite okay. Time being, I believe if 100 holds, we'd stabilize a bit. It would need some consolidation to get out from this sell-off. So I would say time being, stay away. But the bigger picture, if you have a longer term view, I don't think things change significantly. Yeah. In the near term, the froth would go because the rate at which some of these moved, I mean, if you look at some of the PE ratios, I think they were going overboard.
All right, that's the view. The longer term story is intact. But I'm afraid with that, we've come to the end of the query segment. Hemen, what are you recommending for our viewers this morning?
Frankly speaking, it's a very difficult answer, Nandita, because the way the gap down is expected, it's going to be difficult. And I don't think one should chase the gap down and go short because, yeah, there is a corrective bias in the market. But I still feel that the setup remains more positive than negative. Ideally, one would avoid, but I have a buy call on Adani Ports. We spoke about it. It looks good. A lot of relative strength coming in. And I think it can outperform. So one can buy. I'm giving a slightly lower level, indicating a possible downside, which we are seeing. A buy on Adani Ports at 1250. So stop loss 1225, target 1300. Second one is a contra buy call. UPL has virtually fallen off the cliff, Nandita. And now yesterday we've seen a high volume upward bar reversal coming in. So it's a contra buy call on a reversal. So one can buy UPL at 472, stop loss 462, target 492. I would just wait a bit for the markets to open, not chase anything because the markets are we'll have to see how bad it's going to be in the opening and where we see support coming in.
All right, of course, bracing for a weak start, a subdued start, in fact, a gap down open on the index. With that, Hemen, thanks a lot for taking out time and joining in and sharing your thoughts with us. As always, it was a pleasure having you on the show.
Same here.
Well, with that, we've come to the end of this edition of Morning Trade. Of course, bracing for a weak start, and of course, we'll be seeing a lot of red on the screen today. But let's see whether or not we manage to stabilize around midday or not. But with that, it's a wrap. Thanks a lot for watching. But of course, stay tuned because lots coming up on the other side.